You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. Now today I want to talk to you about why it's important to look at the fees that you're paying when you're investing, okay? Now, fees are generally marketed to look like they're actually quite low. When we look at the compounding effect that they have on your investments, this can actually eat up a lot of your earnings, and over years this is going to completely cripple the headway you thought you'd be making. So when I was mentioning in my passive investing for dividends video that I like broadly diversified and low cost, this cost is referring to the management expense ratio, the MER. Now, if I'm looking at buying managed funds, ETFs, LICs, when it are markets that it has an MER, you're looking for something that is low in terms of the percentage it charges, okay? So the MER, if it's anywhere up now 1%, that's actually going to have very, very bad effects on your returns over time, okay? So when we look at what the MER percentage is, this is going to be referred to in basis points, okay? So if you were to pay 1%, that would be 100 basis points. Now, if we look at the Vanguard funds that I myself have actually invested in, the Australian ASX 300 fund, or VAS, this has an MER of just 10 basis points or 0.1% management fee. Now, why this is very good, okay? When I refer to the earnings you make in the stock market being an average of about 8% over the long term, okay? If we're paying 1% in management fees of that 8%, we're not only paying 1%, okay? We're literally losing 12.5% of the earnings we would have made on portfolio gains. So you're essentially shooting yourself in the foot by buying something with a high MER just for the sake of thinking you're going to make a greater return. Now, the Vanguard founder and the granddaddy of all index fund investing, Jack Bogle, he has a wonderful quote, and that basically says, you get in investing what you don't pay for. So if you're thinking you're going to outperform the market by paying some exorbitant fees to some crazy fund manager, chances are they're not even going to outperform the index over the long term. And if you're paying a high fee for them to then make a subpar performance, you're actually going to get a worse return than what even the market would provide you if you were just buying into a diverse, low-cost index fund and reinvesting dividends over the long term. So it's very important to look at what these fees are and make sure that you're not paying something crazy or there's no hidden performance fees on top of the MER when you purchase. So in Australia, we have some wonderful listed investment companies that boast a very low management expense ratio. These being, Australian Foundation Investment Companies, or the ticker symbol AFI, Argo, ticker symbol AIG, AUI, which is the Australian United Investment Company, and many others, okay? Milton, for example, all of their MERs are between 10 and 20 basis points. So you're not even paying 0.5%, you're paying like 1/10 or 1/20 of a percent, which is amazing. So we're looking for extremely low cost, so that doesn't eat away our returns, yet we can still expect very good performance from these. Now, those LICs I just mentioned, whilst they are technically managed funds, they still provide very good returns to investors over the long term, although past performance is no real indicator of future performance. Though when you look at the dividend return that they have provided to shareholders and the fact that they have increased that over time and they've kept expenses low, this can give you some confidence in making a decision. Now, the next fund that we can look at is an ETF, or an exchange traded fund. Now, the MER that most exchange traded funds boast is usually quite low unless you're looking at a specific sector targeted fund. So if we look at a broadly diversified index fund with a lot of holdings, they're not going to need to do too much rebalancing. Therefore, there's not going to be a lot of management going on. If you're holding the top 300 companies in Australia, for example, and company 29 goes on an absolute bull run and it becomes company 10, that rebalancing is already done by the share price adjustments and dividends reinvesting or whatever like that, because you're not having to have your index fund sell those shares and then rebuy them at a higher price. you already own those shares, they go up, therefore your percentage holding is increasing within that fund, okay? Hence the fund price increases. So index funds are quite passively managed most of the time. When you need to rebalance every quarter, etc., there's usually very little work that needs to be done because, as I said, most of the rebalancing is automatic, allowing these things to happen sort of in the background and not needing even to be done quarterly when it is not requiring a sale and purchase of a new company. Obviously, if company number 300 fails, that gets sold out, and then company 301 moves up into that 300th position, therefore becoming a piece of that fund. Okay, so the MER, or the management expense ratio, of most of the low cost index funds, we're looking at anywhere sort of between 30 basis points and less. The ones I invest in, so the main three that I've mentioned in my very first video, the Vanguard ASX 300, so VAS, this, as I said before, has a management expense ratio of 10 basis points or 0.1%. I then hold VTS, which is the entire United States market of 3,600 companies. Okay, now this has a very, very low management expense ratio of just 3 basis points. So that means for every $10,000 I have invested, I'm only going to pay $3 to have those funds managed. Okay, now when we're looking at the entire broad market returns, we're easily going to make back that $3 out of 10,000. Okay, in fact, we should be looking at a return per annum of about $800 based on the example I gave you of the 8% return before. So this is a fantastic fund, and that is a beautifully low management expense ratio, or MER. The next one that I buy, VEU, this is the entire world market minus the United States. Now this comes with another low cost management expense ratio, or MER, of 8 basis points, or 0.08%, which is just, again, so low. And I'm very grateful to have these low cost index funds because these expenses are not eating away at my returns the same way they would be if, for example, I was paying, 1%, 1.5%, 2%. Now, some hedge fund managers, so if you're investing in a big hedge fund that is actively managed and people, they're paying to work out of an office and stuff, they're going to have expenses that they need covered from the funds that are being managed. So when you have a management expense ratio that's in the high dollar percentage, so let's say it's like 1 to 1.5 to maybe even 2%, this is going to obliterate your returns from the share market. Now, some of these funds, on top of this management expense ratio, they'll also charge a performance fee, which basically they're saying if we can make any sort of returns that outperform the share market, we're going to charge you even more. So here's where people can get tricked out. So if in, say, the year 2021, the share market returns 8%, let's just keep it super simple, 8%, okay? Now, when my $10,000 has gone into this hedge fund, 8% is earned, so I should have 10,800 at the end of this, okay? Brilliant return. Now, the fees that would be charged out of that is 2%, okay? So out of that 800, I've lost 200. Now I'm left with 600, so I've already underperformed the market, okay? Not only is that really bad, then the next year when this compounds, okay, instead of earning another 8%, I'm essentially only earning again 6% because I've lost another 2% in management fees, and this continues on forever. Now, I don't know about you, but if I was paying an extra 2% on my mortgage, this would absolutely destroy me. I'd be losing so much money in interest. Yet people tend to actually ignore this percentage change when they're looking at these managed funds. So what I want to encourage you to do is actually find a low-cost diversified index fund, or ETF, that you want to use. Now, as I mentioned before, some ETFs track specific sectors. So for example, in Australia, we have the FANG ETF, and this holds, Tesla, Facebook, Apple, Netflix, Google. Now this charges a little higher management expense ratio, but there's fewer companies, so the rebalancing occurs a lot more, and therefore it needs to be a bit more actively managed. So that is why that management expense ratio could be justified in an ETF like this. Now you may also have ETFs which track, say, a resource, so one that tracks gold. Now to buy and hold gold, that can actually be very expensive because you have to pay for somewhere to have this stored, or if it's an ETF tracking the futures price of a commodity, that's also requiring a buy and a sell contract of the future of that commodity. So therefore there is a little more active involvement, and that is why there's generally a higher fee in order to hold this in your portfolio. If we look at the overall though, when we hold a broadly diversified low-cost index fund, we're going to have every sector in that. So in Australia, through the ASX 300 VAS, I'm not going to need to worry about diversifying extra into gold companies because the ASX 300 holds mining companies, and then therefore I have exposure to the resources. I don't then need to worry about financials and trying to buy banks because they are already a part of that index. I don't need to worry about Australian technology companies because they are already in that index. You know, we already have Afterpay and car sales present within that. So I hope this gives you guys a really good idea as to why the fees really matter when you start investing, okay? Because the compound returns that you're not getting because you're paying that fee are actually so bad, and over a long time frame, you know, when we're talking 30, 40, 50 years, this can equate to a difference in hundreds of thousands of dollars if you have a lot of money invested, okay? So I want you to really consider that. Now, I hope this makes some sense, and make sure when you're going out and doing some research as to which shares, index funds, ETFs, etc. you want to buy, you're finding ones that tick all the boxes for you. You want the low fees, you want the broadly diversified funds, and you want to make sure that over the long term, you're getting the same return that the market can return to you instead of paying an exorbitant fee for something which actually underperforms. Guys, thanks for watching this video. If you feel like you got any value from this, please hit the like button, comment, share and subscribe, and I'll see you in the next video.